Goldman Sachs says you should prepare for higher prices coming this fall because of tariffs. President Trump didn't like that. He responded by saying this, quote, "Tariffs have not caused inflation or any other problems for America other than massive amounts of cash pouring into our treasury. I think that the CEO of Goldman Sachs should go out and get himself a new economist, or maybe he ought to just focus on being a DJ and not bother running a major financial institution." Well, in response to that, Goldman Sachs responded and they said, quote, "We stand by the results of our study." So what I want to do in this video is explain why Goldman Sachs says that the price hikes because of tariffs are coming later in 2025, that we can understand what this could mean for our economy and what this could potentially mean for your investments and your money as well. Goldman Sachs did a research report, and what they said is that United States businesses have taken around 64% of the hit from tariffs so far, but they expect that their share is going to shrink to less than 10% in the coming months. What does that mean? A tariff is when me as a business, I import something from, let's say, China. Now I have to pay an additional fee because of the tariff to bring the product from China into the United States. So hypothetically, if I was buying something for $100, now because of tariffs, I could be paying $150. And what Goldman Sachs is saying is that previously, I, the business, have been shrinking my profits, and I absorbed 64% of that hike because of tariffs, and I've been passing down just a little bit of it down to the consumer. Well, Goldman Sachs is saying that businesses are not going to be able to continue sustaining this for much longer, and they say that businesses are only going to be able to absorb about 10% of the price hike because of tariffs into the coming months, and then the remainder is then going to be passed down to consumers. So right now, businesses are absorbing most of the cost because of tariffs, but Goldman Sachs says that in the coming months, consumers are going to be absorbing most of that cost when the prices go down. Let's go further into what Goldman Sachs says, because they went on to say, quote, "If the most recent tariffs, like the April tariff, follow the same pattern that we've seen to those in February, then eventually by the fall, we estimate that consumers will bear about 2/3 of the tariff costs, which goes hand in hand with what we've been talking about." And this is one of the things, by the way, we've been covering in Market Briefs. Again, Market Briefs is my free financial newsletter for investors, where every day my team is working to break down what's happening in things like the economy, housing, stocks, crypto, and global markets into a fun, witty, and easy to read newsletter. It's completely free. We have hundreds of thousands of investors that read Market Briefs every single morning. And when you join Market Briefs, you're also going to get access to my investing masterclass as a bonus, complimentary just for you joining. So if you have not started reading Market Briefs yet, I have the link for you to join for free down in the description below. Now, this is creating a very interesting dilemma because we have a lot of entities that are kind of confused as to what tariffs are going to do, because we haven't seen tariffs like this since a century ago. So it's going to be very interesting to see how tariffs play out. And it's very easy to understand how businesses that are importing products from foreign countries could change their pricing model because of tariffs. But I think the part that is very less understood is how businesses made in the United States could affect their prices because of tariffs. That might not make any sense. If I'm a business in the United States and I manufacture in the United States, how could tariffs affect me? Well, take a read at what Goldman Sachs said. Quote, "If you're a company producing in the United States who is now protected from foreign competition, you can raise your prices and benefit." So those are our estimates. And I think actually they're quite consistent what many other economists have found. In other words, Goldman Sachs is saying, hey, if you produce your products in the United States and now your competitors who used to import their products from China or India or whatever other countries are now facing tariffs and are facing these higher costs, they might not sell their products the way that they did before. Or maybe they're going to start raising their prices because of these tariffs. Well, now you, as the American company, have essentially less competition. And what does competition do in business? Competition helps keep the prices of things low. Competition is good for consumers, is good for people. It's not good for businesses in that sense, because, well, then competition forces businesses to find cheaper or lower costs. And that's where you want to understand the difference. Now, I get it. Competition can help with innovation and all that other stuff, but I'm focusing just on prices for the purposes of this video. And this is where Goldman Sachs says, well, businesses that are importing the products from foreign countries, they're going to start passing their costs down in the coming months. Businesses that manufacture in the United States, once they see that these companies from foreign countries that are importing their products are raising their prices or not selling their products, these companies that are producing products in the United States will then also have the opportunity to raise their prices, and that is ultimately going to hurt the consumer because they believe it's going to cause the prices of things to go up. But how long is the impact going to last? This is also a big question mark, and Goldman Sachs did address this as well. This is what the chief economist said, quote, "I do think most of the impact is still ahead of us. I'm not worried about it. I think, like the White House, like the Federal Reserve Bank, we would see this as a one-time price level effect, essentially transitory inflation." We all remember that term, right? I don't think this will matter a whole lot to the Fed because now they have a labor market to worry about, and I think that's going to be the dominant concern. What does that mean? Essentially, Goldman Sachs is saying, number one, that this price impact because of tariffs, this inflation because of tariffs is going to be short term. So they're saying it's going to be a transitory inflation just once we get adjusted to tariffs. But then they go on to say that these tariffs are not going to influence what the Federal Reserve Bank does. I just made a video talking about this, about how there's more pressure on the Federal Reserve Bank to cut interest rates. And the reason why Goldman Sachs is saying that is because they're saying that, well, we have other concerns in our economy, which concerns the job market. You may remember that we published this in Market Briefs. I also made a video about this last week, that we got a new report from the Bureau of Labor Statistics saying that our job market is much worse than expected. Why? Because not only did we get a bad job report number in July, but it turns out that in the months leading up to July, we actually added way fewer jobs than we expected. Horrible job numbers. And when President Trump saw that, that was when he proceeded to fire the Bureau of Labor Statistics because he said that that data is wrong. But we'll ultimately see what ends up happening with that. But this is where Goldman Sachs is saying, hey, you know what? The Federal Reserve Bank has other problems, such as the job market. So they're not going to be concerned about the price hikes. So they're not concerned about inflation. They're more concerned about the economy. Why does that matter? Because the Federal Reserve Bank is the entity that decides if they're going to cut interest rates or lower interest rates. And it's a balancing act between inflation and the economy. When inflation is a problem, we remember that 9% inflation a couple of years ago. When inflation is a problem, the Federal Reserve Bank is going to raise interest rates aggressively because inflation is a bigger problem than the economy. So the Federal Reserve Bank raised interest rates to bring inflation down, which cooled down the economy. Now we have a situation where inflation is not as bad as it was before. I mean, we still have all the previous inflation, but the rate of inflation has cooled down, but the economy is starting to cool. So it's kind of a different scenario, the opposite scenario than a couple of years ago. And now the Federal Reserve Bank is going to have to decide what's more important. Is it stimulating the economy and making inflation worse, or is it keeping inflation down and making the economy worse? And Goldman Sachs is kind of hinting that maybe the Federal Reserve Bank is going to say, you know what? Let's start cutting interest rates to stimulate the economy because of these bad job market numbers. And even if these lower interest rates make inflation a little bit worse, oh well, that's not as big of a deal as the bad job market. That's what Goldman Sachs is hinting at. Now, of course, these are things that you want to pay attention to because interest rates are kind of like the lifeblood of our economic system because our economy runs on spending. And there are two types of money in our economy. There's actual money and then there's credit. And we live in a credit-based society where people can spend money they have in their bank, or they can spend money from their Visa or their MasterCard or with money that they borrow from the bank. And in the economy, it doesn't matter if you're borrowing money and spending money or if you spend money from the bank. Why does that matter? Because lower interest rates encourage people to spend more and encourages people to go out and borrow more, which can be good for the economy, but lower interest rates can also make the inflation problem worse. Why am I telling you this? Because if inflation does become a bigger problem in later 2025 or 2026, well, you want to be prepared for that because a lot of people still aren't ready to deal with the inflation that we're seeing today. And as somebody who needs to take care of themselves and their families and their communities, you should understand how inflation works. And I've been talking about this a lot, but the reality is inflation disproportionately benefits some people over others. What do I mean? Inflation makes investors richer, while it makes everybody else poorer. Why? Because inflation makes it more expensive when you go to Chipotle and you want to buy the extra guac. Inflation makes your rent more expensive. Inflation makes costs of things more expensive. It makes consumption more expensive. So that means your salary doesn't stretch as far and your savings don't stretch as far. So if you're not seeing a raise big enough to meet or outpace inflation, your salary is essentially getting smaller. Even if it's getting bigger, it's in reality getting smaller because it doesn't buy you as much stuff. Likewise, if your savings don't grow fast enough to keep up with inflation, well, now your savings are essentially making you poorer, because even though your savings might be going up, the value of your savings are going down. While at the same time, investment values generally go up because of inflation. We've seen this happen decade after decade after decade. Now, I'm not saying that recessions don't happen. I'm not saying market crashes don't happen. In fact, we know that they happen. We know that a recession is coming. We know that a market crash is coming. We just don't know when. And that's the part that I want you to remember and understand. That if there are these signs that, hey, inflation might be a bigger problem in the near future, you need to understand this and need to make sure that you are protecting yourself. And then when it comes from an investment opportunity, well, of course, there are certain companies that are primed to benefit when inflation happens. I mean, when inflation happens, people want to be more cost conscious. They want to be more careful with how they spend their money. There are certain companies and stocks that could benefit from that. Lower interest rates could also benefit other types of stocks, and you want to be aware of that. Make sure you can benefit from those things as well. That's why I want you to start thinking like an investor. Obviously, you got to make sure you take care of your finances first, but then you want to start thinking like an investor. That way we can understand where the opportunities are. Again, if you're looking for some additional resources, Market Briefs is a free newsletter that will keep you up to date on what's happening. And then my firm also publishes a paid report called Briefs Pro, where we help investors stay up to date on where money is moving and how it creates investment opportunities, should that be something that you're interested in. And with that, I will see you on YouTube on Monday. America is entering a debt-death spiral.
When debts rise relative to incomes on a chronic basis, right now for the U.S. government, it's almost $1 trillion a year that goes to interest payments. When you run a large deficit, you have to sell debt to do that. And when I calculate it, the quantity of debt sold to be sold is much